In this video I'm going to show you how Nevisian posts to the chart of accounts when you sell your items before you know the actual cost of them, or in other words, when you sell before buying. But before you watch this video, I strongly recommend you watch the basic scenario video, which will take you over the basic scenario postings. But first I'll go over all the postings on a number of slides. The first slide will be a receiving slide, the next slide will be a ship and invoice slide, and the third and final one will be a purchase invoice slide. This should give you a complete understanding of the bookkeeping and accounting side and why Nevisian posts as it does. When you have a full understanding of why Nevisian posts as it does, I will first show you how to set up Nevisian to perform this demonstration, and then I will create a purchase order which I will receive. Then I will create a sales order which I will ship an invoice, and finally I will go back to the purchase order and invoice it. I will also have a look at all the transactions and the documents created from these actions. So in this case of selling before buying, the flow is that we create a purchase order of one item which we will receive at an expected cost of 8. We then go, without invoicing it, we go to the sales, to a sales order which we both ship and invoice. And then we go back to the purchase order and then we invoice it, now at a cost of 10. So the flow is that at the point in time where we receive the good or the item, we haven't received the invoice from our vendor. So we don't know what value to put it on inventory at. In fact, we don't know the value until after we have sold the item, which is of course a problem, because how should the cost of goods sold then be handled? In this case, I suggest you to switch off expected cost posting. It will also work if you have expected cost posting switched on, but it's easier to have it switched off, because then we won't get too many entries. So for the first step, when we go to the purchase order, put in the line and receive it, because expected cost posting is switched off, we are actually not going to have any financial impact when receiving the item. If expected cost had been switched on, we would have gotten some financial impact. So the next step to do here is to go and ship and invoice the item from a sales order, and this creates 5 GL entries. So these 5 here, and the 5 that you've got is the 3 sales entries, this one, which is the account receivables, or how much our customer owes us. We have a VAT entry, and we've got a sale of $20. So, but because the expected cost, because we received it at an expected cost of 8, we also have cost of goods sold. So it's a reduction in inventory of 8, and our cost of goods sold is also 8. So on this last slide, we finally received the invoice from our vendor, and it turns out that the item we bought and the item that we initially thought would cost $8, it turns out that it actually cost $10. This also means that our cost of goods sold and the cost of goods sold here and the reduction in inventory wasn't exactly accurate. We put it in for $8, but it turns out now that it should have been $10. So this step the third step is handled in this column, or illustrated in this column. So I've and this creates 7 GL entries in total. So when you go to the purchase order and you invoice, Nevisian creates 7 GL entries in total, namely these 7. So in order to understand what these 7 entries are, I have divided those into 2 different colors. So the first one, let's start with the green one here. The first ones, all those that are indicated with green, could be considered a normal purchase transaction. So we know now that our inventory, or the item that we're putting on inventory, should be put on inventory at a cost of $10. We've also had a purchase of 10 in our cost section, but because we don't have any, because this doesn't represent a cost initially from the purchase transaction, it has been pulled out of the cost section and put into the inventory. So if you have watched the basic video tutorial on how Nevisian posts a normal purchase transaction, this should be quite common stuff to you. So, but what has happened on top of this normal purchase transaction, those 5 normal purchase transactions entries, is that Nevisian has created 2 additional GL entries, and this is to increase both the inventory. So you could consider these 2 as 1, making up a total of 10. So in fact, it has updated our previous the GL entries that was done when we shipped and invoiced. It has updated those. So if we look back at this column, the ship and invoice, and consider our profitability, because additional 2 have been posted to the cost of goods sold, we now have an accurate profitability. So the total on this account, cost of goods sold, is now 10. We still had a sale of 20, so we've made a total profit of 10 because we have increased the value of the goods sold from 8 to a total of 10. And this increase in cost of goods sold is also recorded on the inventory, so that when we look at this as a whole, it looks like we have bought items and we put those items on inventory at a value of 10, and when we sold the items here, we have pulled that out of inventory also at a value of 10, and our cost of goods sold is a total of 10. The confusing thing here is that usually you would receive your purchase order, then invoice, and then you would go to the ship and invoice. But here you do it the other way around. You receive and then you skip to the end of an otherwise normal chain, and then you go back to the purchase again. Okay, so let's first have a look at how Nevisian is set up in order to perform this demonstration. The first thing we can look at is the chart of accounts. And in the bottom here, I have made a mini chart of accounts which is identical to the one that I used in the slides. So you need to set up all these accounts just as they are here. The next thing we can have a look at is the inventory setup. And I have set automatic cost posting to yes. Expected cost posting should be switched off. As a matter of fact, you can run this exercise with expected cost postings switched on, but it will create extra transactions, so I recommend you switch it off to make it more easy to understand the transactions. And the rest of the inventory setup should be set up as you can see on the screen. Then you need to set up your general posting groups. And I have created 2 general posting groups for this specific exercise. Those 2, and you need to set this up with the sales account, which points to your mini chart of accounts to the sales account. You need to set up your purchase account here, and then you need to set up your cost of goods sold account here, and your direct cost applied account there. Then you need to set up your inventory, your inventory posting groups. I've created an inventory posting group just called inventor P here, and all you need to set up is the inventory account as this. Then we need to set up the vendor posting groups, and I have created just a vendor posting group called vendor, and you just need to set up your payables account here to point to your payables account in your mini chart of accounts. And the last thing you need to be aware of is your customer posting groups. And I've also created a customer posting group just called customer. And this points, and you just need to set up your receivables account here, and it points to your debtors or receivables. So that does it for the setup of Nevisian. Okay, so before we get started, I suggest you just switch the work date to a day where you know you don't have any transaction for this particular item. So I'm gonna do that here. And the first thing we need to do is to go to a purchase order and create a new purchase order. And we need the purchase order to be created for, I have created an item called glass 2, which I'm selling from location blank, and in the buying to location blank, and in the quantity of 1. So right now we have an assumption that it's going to cost us $8, and we start by receiving it. So that means that we are physically receiving the good or the glass, but it doesn't come with an invoice. So we don't really know what the vendor is going to invoice us eventually. So we say receive, and we can check the receipts now for this particular purchase order, and if we navigate on that one, we'll see that it hasn't created any GL entries, just as on the slide. So the next thing we need to do is to create a sales order. And we'll create a new one. And also this one should be created for the item glass 2. And we should sell it from location blank and in 1 quantity. We want to sell it for $20 before tax. So we both ship and invoice this one like this. And we can then go and look at the posted sales shipment. It's not It's not the most interesting document here, but I'll show you anyways. And it's not interesting because no GL entries are attached to this one. However, when we shipped and invoiced the sales order, it also created a posted sales invoice, which has the GL entries that we are looking for. So if we navigate on this one, we'll see those 5 GL entries, and those are exactly the entries that we had on the slides. We have the sales entries here and the expected cost of goods sold here. So the next thing we need to do is to go back to the purchase order, which I've hidden back here, and now we are getting, maybe a couple of days or maybe a week later or maybe a month later, we are getting the actual invoice, and it's not until now that we know what the glass actually cost us. So it turns out from looking at the invoice that the vendor wants us to pay $10 instead of $8. So we'll have to just reopen this one in order to modify the data. So we'll change this to 10. Just for the principle, obviously we could also receive an invoice where the price is less. Maybe the vendor has decided to give us a discount based on the quantity of goods we're buying from him, or maybe there's some other reason for why the cost of the good is not exactly what we expected it to be. So in order to get on with this one, we also have to indicate a vendor invoice number. So now we can invoice this purchase order, or we can also just receive and invoice because we have already received all of the order. And if we go to our posted invoice, purchase invoice, which has now been created here, and we click, this is the one for the glass, and we click navigate, we'll see that it has created 5 entries. So based on the slides, I told you that it should create 7 entries, and it has created 7 entries, but 5 of them are found here. So you have your purchase transaction here, and you have the 2 transactions that are responsible for moving the cost from the moving the cost from the cost section into the inventory. And the last 2 entries, or GL entries, it has created cannot be found here. It needs to be found from the sales invoice, the posted sales invoice, which a moment ago had only 5 entries connected to it. But if we find it now, and if we navigate, we'll see that now it doesn't have 5 GL entries as it did before we posted the purchase order. Now it has 7. So and the 2 that it has just created are those 2 here. So those are the adjustments created from the invoicing of the purchase order. And if you go back and have a look at the slides, you will see that this invoicing of the purchase order, it created 7 entries, and you will be able to recognize these 2 as the adjustments for the true cost of the good, the true cost of goods sold, and the true reduction in inventory. So that wraps it up for the case of selling before buying.